When was the last time that your bank phoned you to offer you a better interest rate on your mortgage? I reckon it'd be fair to say probably never. And there's a good reason for that. The longer that you go without reviewing your home loan, the more money the bank is going to make. Now, banks rely heavily on borrowers being lazy, and that's why it's essential to work with a broker who has your best interests at heart. There are plenty of reasons why people would want to refinance their home loan, and everyone's reason is a little bit different. So here are some important things to consider. Firstly, the interest rate. Don't assume that the lowest interest rate is always going to be the best deal. It's important to consider the total cost of refinancing, such as exit fees with your current bank and establishment fees with the new bank, as well as any ongoing monthly or annual fees that the loan might attract. Remember, the annual fee itself could increase the interest rate by as much as 0.25% on a small loan. Secondly, the loan term. When people refinance, they tend to re-extend their loan term back out over 30 years, and they don't actually realise what this physically costs them. If you do this, then you may as well throw the interest rate out the window altogether. I'll give you an example. Let's say you have a loan for $500,000 over 30 years. 5 years into your 30-year loan term, you refinance for a further 30 years, effectively making your loan 35 years from start to finish. Now, if you've previously done this, you've likely cost yourself over $90,000 in additional interest, and that's without even knowing it. At the risk of sounding conservative, this is probably the worst thing that you can ever do when you refinance. It adds years to your mortgage and it costs you tens of thousands of dollars in additional interest. And finally, consider your repayment when consolidating credit card and personal card debt into your home loan. Now, there are times in life when everyone spends more than they probably should. Don't feel bad, it happens to everyone. Credit cards build up, an unexpected expense. You try to pay it off, but it's near impossible due to the high interest rates. Did you know that the minimum monthly repayment on a credit card is not geared to paying it off quickly? And that's why people wonder why they aren't getting anywhere. The banks are setting you up to fail. The same way that the interest rate and the loan term are important, how you manage your debt after consolidating it into your home loan is also important. Here's the thing, by rolling credit card debt and personal debt into your home loan, you're effectively turning short-term debt into long-term debt. And the best tip that I can give you here is to roll all your old repayments into one consolidated monthly repayment. For example, if your home loan repayment was $2,000 and your credit card repayment and personal loan were $1,000 a month, aim to pay $3,000 a month on the new loan once all the debts are consolidated, regardless of the fact that your new loan repayment will be lower. This allows you to take advantage of the low home loan interest rate and stay away from the crazy high credit card interest rates. Now, if you have any questions, we'd love to hear from you, so please reach out. Look forward to speaking with you.